Hey everyone, thanks for joining me. In this video, we're going to be going over Penn Entertainment's business, what their strategy is, how their performance has been as of late, and then we're going to wrap up by talking about their stock and their valuation, and if I think it's a good buy at this price, or why not I'm considering buying or not buying the stock. If you like this type of content, please hit the like button, subscribe to the channel. We have a lot more content like this, as well as just other portfolio videos and anything stock related. We really talk about it all on this channel. So to get going with this video, Penn Entertainment owns a plethora of assets across gaming and entertainment. Going back a few years, they're primarily a bricks and mortar casino company. You can kind of see all of the casino and racetrack physical assets that they own, and that's really still the cash cow of the business. But what they've really done over the last few years is invest in acquiring new companies, most notably Barstool Sports, as well as The Score, which is a Canadian media and gambling company as well. So now they own those two in their digital footprint, and they're really looking at driving synergies across their bricks and mortar space with these digital assets that they've bought, and how can they really streamline the back end to maximize monetization across the board. Looking at their strategy, couple things that we just talked about. We talked about efficiently monetizing across channels. That's what we just talked in terms of how can we leverage the unique combination of assets that they have at Penn to maximize monetization. One other thing they're focused on is building the ecosystem of their customers. So this is really where having this media division with Barstool Sports and with the Score media up in Canada, most notably Ontario, is really important to just fueling demand for their online products, and also in some instances their physical bricks and mortar casinos as well. So we'll talk about that a bit more as we go on and see the growth that they're experiencing, most notably on the online portion behind the ecosystem. And then one thing that they are really focused on, obviously everything digital, whether it's iCasinos, sports gambling online, is really core to their future growth strategy. So they have been investing a lot in new products, new technology to be able to enable their strategy of really winning and growing market share in that space that's still kind of on the cusp of being developed. When we look at them geographically, you can kind of see where they play. So more northeast U.S., some areas in terms of online sports books and Barstool in the middle of the U.S. and kind of southwest U.S., and then The Score is really primarily in Ontario, and that's just the media and gaming asset that they acquired not too long ago from there. So decently diversified business in terms of the amount of states they play in, but this is essentially a complete U.S. play with the exception of having The Score there as well. Looking at their financials, so this company is really investing really heavily on the digital front in sports gaming and the licenses and building out the infrastructure, as well as the iCasino and synergizing the acquisitions that they've just recently made with Barstool and The Score. But they've done a good job of at least maintaining break even to slight profitability over the last 1 to 2 years as they've kind of gone through this transition. Their top line revenues are flatlining, so I think their physical casinos, they own a lot of regional casinos, have been declining a bit, and this growth is really being driven by the revenue they're getting from the online sports books and iCasinos. Obviously, that's a less profitable set of revenues, which is impacting income levels as they're requiring more investments in those channels, and they're just less, the economics are still being kind of figured out and built up. So I like to see as a potential investor that they are still at least, let's call it break even. $20 million on a company this size isn't a big deal, but it's good to see that they're not losing money at these stages, which is, I guess, a good first step in not like diluting shareholders and bringing on more debt to make their strategy come to life. it's great that they have the cash cow of the physical casinos as they kind of go through this journey of digitizing the business. And then when you look at the total year looks a lot better. On net income, their net income margin's 3.5% instead of 1% that it was in Q4. So I won't, harp on Q4 too much. It's just a couple months. But on the total 2022, they made over $200 million, which, is more than just break even. They're at least squeaking out a profit. But I do think it's more upside in that net income number once they kind of scale the digital side of the business that they're currently investing in. For 23, they think they're going to grow or not even grow. Essentially, let's call it very similar revenue as this year with very similar revenue or adjusted EBITDA numbers, no net income guidance. So they're essentially projecting a flat year. I think that's probably going to equate to a net income hurt because they're projecting growth on the less profitable side of their business for now, which means that they're probably projecting a slowdown on their physical casinos in order to get to flat. Okay, for the balance sheet side, they call it out and highlight it as healthy. I don't know if I'd go that far. 4.5 times net leverage, $2.7 billion in debt, gross debt for a company that I think they have a value under $5 billion market cap. So they are more leveraged than I'd want them to be, especially in this kind of business. Like when things start going bad in the economy, these are channels or products that people do not need in their life. So they tend to get hit more volatile earning stream. So I really prefer them not to be leveraged to the point that they're going to be in trouble in terms of paying this back or how much the net interest rate is going to be pulling from their ability to invest in their business if revenues do slow down over a short period of time. So this is kind of like my first red flag. I want this number to be a lot lower, preferably closer to 3 than 4.5. And then in addition to that, it's a bit concerning that they're calling it out as healthy when it's at 4.5, and that they're repurchasing stock while they have this. They currently don't think this is a problem, which I'm a bit wary of as I'm looking at this business. Going into their interactive segment, so this is kind of where they're really focused on growth in terms of their iCasinos, their online sports books, and their media divisions that they've been investing in over the last number of years from an acquisition perspective, but also internally to make the back end of them all kind of correlate to each other. So not everyone is so they can have some operating scale in operating different sports books, because they kind of had a Penn online betting platform. Then they bought Barstool Sports, who also had theirs. Then they bought The Score. So they had 3 different online betting platforms, all with different operating costs. So they kind of just streamlined that into one, made big investments internally, but obviously the right thing to do long term. And then they have recently bought out 100% of Barstool Sports for about $400 to $500 million. And I guess if there was one good sign on this, is just the sign that this division has line of sight to profitability. This is an adjusted EBITDA number, so not net income and not even real EBITDA. So take it with a grain of salt, but it's good that it's not like extremely negative or something like that. As they continue to focus on growth here, and in Q4 they grew 17%, so good growth. I'm hoping that there'll be a lot of scale because of the fixed investments that they put into this, and they'll be able to make this a profitable division of their business, which ultimately, if you're investing in this company, you're counting on, because their regional casinos are flat to down, it seems like. So this is really where the business is going, and if you don't believe in their interactive segment, you probably shouldn't be buying the stock. Now, just looking at some of the momentum they have, their revenue, which is, I think, what they're taking away, is kind of classified here on the left-hand side. This is their total handle, so the total amount people are betting, but then some people are winning money back. So this is just a good sense of volumes, whereas this is actually revenue as long as I'm understanding it correctly. So you can kind of just see quarter over quarter the growth they're seeing on how much money is going through their system. Very promising signs for their iCasino that they've kind of built and focused on, and we're seeing it really correlate well into how much revenue they're making. 41 million or 42 million to 63 million, so about 50% growth versus last year on that, which is really promising to see. And then on the Score acquisition, you can kind of see similar trends. Both iCasino and sports betting are both trending upwards quarter over quarter. Nice to see pretty much 1, 2, 3, 4, 5 straight months of all-time highs month over month sequentially in terms of revenue they're generating from those channels. So that's really promising, and hopefully we continue to see that grow in 2023. But at least where they're focusing and kind of betting the business on, they're seeing top-line growth, and they're working on driving those synergies to enable that to flow through to the bottom line. We're just not seeing it yet. Another thing behind the Barstool Sports brand, they're looking at how can they leverage this brand and bring younger people into their casinos, into their physical footprints, whether that's just sports bars or that's betting stations within casinos. So they're really betting big on this. Recently opened 4 retail sports books in Ohio, 1 in Massachusetts, and they're looking at putting in more permanent locations in Q1 and really experimenting with how far they can bring this Barstool brand outside of the media division, whether that's just sports bars or media events or whatever it may be. So good to see that they do see a long runway for that brand and they're focusing on it. Okay, just going back to this slide before talking about the stock, you can kind of get a sense, as we talked earlier, this is their core business and what's really enabling them to invest in acquisitions and fuel growth on the media and digital side of the business. But this is a really important side of their business right now that's generating cash flow, net income to enable them to make these investments that are losing money right now without taking on more debt or without diluting shareholders. So I think this is a really important part of the business to make sure it's operating well, and it seems like it's doing okay, which is a good sign. And that's really enabling them to invest in bringing new products and use good user experience for sports betting, media, online gaming. And that's really their strategy as you saw it in the prior slides. So going on to their stock's had a bit of a wild ride, was kind of trading $20, $25 before the pandemic, went down to like $5 a share just during that craziness as all regional casinos had to shut down. And at the time, that was even a bigger part of their business. They didn't own these digital assets. And then after they acquired those digital assets, vaccines got announced, everything boomed, stock went to over $120, like $20 billion value, which is nuts. And now we're back down slightly ahead of where we were before COVID, in the high 20s. So the company's currently valued at about $4.7 billion. We saw they're doing $220 million of net income in 2022. Will probably be similar in 2023. So the company's trading at like a 22, 23 times earnings multiple, depending on how they do this year. But let's call it a low to mid 20 earnings multiple. They have a bit of secular decline, it seems like, on their traditional casino business, but potentially a lot of upside on their digital business. So my thoughts on this company, I don't think it's crazy valued or anything like that, but just given the uncertainty and the competition in the digital sportsbook space and the iCasino space, I don't think it's a company that I'm willing to give them the benefit of the doubt on mid-20 multiple. Just because their core business, while it's being stable, it's not really growing as well. So this company and the investment in itself is kind of betting the farm on those online sportsbooks assets that we're not sure how they're going to do. To be more interested in this company, it would have to either be at a lower multiple to make me feel more confident about the potential upside, or I need to see the economics of iCasinos and the sports betting space improve as a category, just to protect myself from the downside of that risk. So either waiting a couple more quarters, seeing the EBITDA numbers on their interactive division increase dramatically, or the multiple to come down closer to like a mid to high teens are two kind of catalysts that would get me more interested in this stock. But with that being said, let me know what you guys think. Do you guys own this stock, or are you guys interested in this stock? If there's any stocks you're interested in and you'd love my opinion on, would love for you to let me know in the comments as well. And I'll see you guys in the next one.